Hello YouTube. Step index on a 15 minutes time frame. Today's talk is about this month end consolidation. Right? It is a consolidation. It goes nowhere. It consolidates within a particular range. It can be 50 points, it can be 70 points, it can be 100 points. But for this one, we are having about 37 points of a consolidation. It's going back and forth between that range. Okay. You know how I teach about order blocks? That order blocks are essential in a consolidation market? Yes. But this lesson is different. This one we are talking about inefficiencies. Inefficiencies in a consolidation market? Are you out of your mind? Order blocks are essential in a consolidation market. Yes, I agree. But there's one thing that you guys are not paying attention to. And I have been giving hints a little bit, just a little bit of hints of what I'm about to talk about. It's found in all of the commentaries that I have been pushing. All of the commentaries. You're not paying attention. But here it is. Here is the lesson. Okay. When you find yourself in a consolidation market in step index, you are going to refer to the first inefficiency that begins the day. That inefficiency you're going to pay most attention to. Why? Why do you do that? Well, that's because the first inefficiency of the day, it tells you what you need to do. Okay? That's it. You just need to watch out for the first inefficiency. So let me give you guys an example of what I'm talking about. We know that the market is consolidating, yes. But see, the very first inefficiency of the day, what do I teach about the new trading day? That it tends to spool, it tends to move quickly. So when it moves quickly, it often leaves these imbalances, the fair value gaps. Okay? So we have our fair value gap because price action, when it begins the new trading day, it rushes, it moves quickly. So that quickness often leaves a fair value gap. This happens only when we begin a new trading day or when we begin a new trading week or when we begin a new trading month. You will have your first inefficiency of the day. Okay? So here it is. What do you do with that inefficiency? Well, price action does not want to leave inefficiencies open. In a consolidation market, that inefficiency is not going to stay open for too long. Okay? It's not. So here is the inefficiency. We are trading inside of the inefficiency. Okay? When we are inside of the fair value gap, you want to trade long. You want to go long. If the inefficiency itself that begins the new trading day, it is bullish, when it comes back into that inefficiency, you're going to go bullish. Okay? So how do you go bullish? You go into the 1 minute time frame. Okay? Here's the 1 minute time frame. And inside of the 1 minute time frame, you are going to select an inefficiency that is in your favor of your buyers. Okay? How do you do that? With order flow, of course. There's this inefficiency here. Do you see that? That inefficiency. Right now, we are trading below it. That's normal. It's a consolidation market. It's going to refer back to order blocks. Okay? But that particular inefficiency there, you will wait for price action to get above the inefficiency itself. That's your confirmation. When price trades above this inefficiency here, then you will open your long opportunity. What does that mean? Why did you pick out this inefficiency and not that one and not that one or that one? This one is inside. It is inside of the 15 minutes time frame, first inefficiency of the day. If we pull out our Fibonacci, okay, we pull out our Fibonacci, you can clearly see the 50% of that fair value gap where it is situated in the consequent arrangement of the 15 minutes time frame fair value gap. So when price gets above the fair value gap itself, the blue one here, you will treat the high of that inefficiency as a support. Why do you do that? Well, that is the 50% of this inefficiency of the 15 minutes time frame. Do you get it? It is order flow. So when price trades above the inefficiency here, you will watch if price action comes back into the 50%. And when it comes back to the 50%, how often does it stay in that 50%? Or the question should be, are we respecting the 50% level? That's it. That's your confirmation. If price stays above that 50%, it trades higher. That will be a high probability setup. Highest probability. Okay? You're using order flow to qualify the setup. So immediately when we stay above that particular 50%, that tells you that price action is bullish. Okay? So for now, we can clearly see that price action is creating lower lows, lower low. But once we trade above it, do we come back to create another lower low, or do we stay above the 50%? That's it. So now we are trading above the 50%, and what you're going to see is price action stay above that 50%. It's going to stay above that 50%. And when it does, that is when I will go for a long opportunity. That's it. Those are the criteria that you require inside of the 1 minute time frame. But enough of that. Let me see what I can show you in the other day. Okay, let's scroll back. Let me give you different examples of the first inefficiency. Okay, here is the 27th of November. We've had a market that is consolidating, going back and forth, back and forth. We begin a new trading day, but we don't have our fair value gap. No. If you are going to say that this tiny fair value gap is the one right there, that one there, that's your fair value gap? No. Nope, that's not it. Why? That fair value gap is tiny. Not only is it tiny, but there's no volume associated with the first fair value gap here. So price continues to consolidate. But this one here, it has volume. Look at the big ass candlestick. Boom. It's huge. Have we had a candlestick larger than that one since the opening? No, we've stayed in a consolidation. But all of a sudden, we have this huge candlestick. That is your first fair value gap. That's the one you consider your first fair value gap of the day. Once price action comes back into that inefficiency, that is when you will go into the 1 minute time frame to qualify with order flow for the setup, if it's valid or not. But should price stay above that fair value gap, the first fair value gap of the day, that, my guy, is a high probability setup. Look at that. It rushes to the upside. take profit hit, clean setup. That's what you are taking, the relative equal highs up there. But sometimes, if you're going to attack these highs up there, sometimes price action may not get into that particular high. So you need to close as soon as we hit this bearish order block here. As soon as we touch the opening price of that bearish order block, that's your exit. That's it. When price action comes back into the first fair value gap again, this one here, the very same fair value gap, we are still utilizing that inefficiency. Okay, price comes back in there. Look at this. It does not spend too much time mingling inside of the fair value gap. It does not spend too much time. Immediately, it goes up. Why? Why, my guy? Why are you telling us this now? Oh my goodness. Well, let's see. Look at this, my guy. Look at this. Okay. Look at the 1 minute time frame. Are we above the fair value gap? Yes. Are we going to stay above the fair value gap? That's the question. You already know the answer. It's going to go bullish. Why? Because there's relative equal highs up there. There's buy side liquidity up there. Who's up there? The resistance traders, resistance and support type of traders. Yeah, you are basically trading that way. You're using that idea, but you're using it with the first fair value gaps of the day. Okay, so these are the two examples that you will attempt. Okay, sometimes your first fair value gap might not seem like it's going to form, but it forms just a few hours of the day, then it forms. So that is one example, and this one is probably the easiest fair value gap of all. This is how I trade, good people. This is how I trade the month end consolidation. Okay, why do we return back into the first fair value gap? That's because we are consolidating. We are consolidating. We are always going to refer back to inefficiencies. And the very first one is of the most importance because we begin a new trading day with an inefficiency. It's very suspicious. Price action cannot open and start running, start spooling into liquidity pools. No, it doesn't do that. Okay? It will come back to rebalance the inefficiency and then it will go into the intended direction. So anytime it comes back in there, you are there. You are there, my guy. With a big lot size. I'm kidding. I'm kidding. But that's about it. That's about it. That sums up how to trade the month end consolidation. Okay? Toodles.